And this is Jim Barlow of OakTree Premium Finance. Happy to talk to all the new people that are attending today to learn a little bit about transforming life insurance into a powerful wealth building tool. As you have questions, be sure to text them in, and we'll see if we can read them and answer them at the end. Well, here we are. Transforming life insurance into a powerful wealth building tool. For centuries, alchemists sought to transform lead into gold, unlocking wealth and enlightenment. I'm going to show you how life insurance can be transformed into a powerful wealth building tool. By the end, you'll have some tools to explore this strategy yourself and become a modern alchemist. Welcome to the new alchemy of wealth creation. So who am I? My wife's name is Barbara. We've been blessed with 7 children, 28 grandchildren. I graduated from BYU, where we remain devoted fans. I worked as an investment advisor for 35 years. Our passions today, we love to travel. We visit loved ones. We enjoy family vacations. We read, we attend plays, we treasure time with family. We serve in the temple and strive to be disciples of Jesus Christ. Above all, I believe in doing good and helping others. That's a picture of our family reunion picture in 2024. We do a reunion every 2 years. The numbers on the shirts are the order when they join the family. So I was talking to Barbara this last week. I'm 1 and she's 2. And I was telling her we need to change that, make her number 1 and I'm number 2. But you can, we're working on a Christmas card that'll be similar to this theory here. Anyway, let's get started. You know, what is alchemy? Transforming life as we know it to something better. It's people that ask the question, is there a better way? Is there a better way to do whatever? It could be taking pictures. At one time we had film with Kodak. Then we had digital cameras. And most people on vacations, I see, they don't even have a camera. They just have their phone today. Wow. Life changes. Smartphones, the internet, cloud storage, online banking, retailing, ChatGPT. I use it. Self-driving cars, health, human potential. There's so many things, and it's going to continue to go forward. Is there a better way? And we need to be willing to listen and look at the better ways that people propose. So this is nothing more than finding a better way. I'm going to blend life insurance, a growth strategy, and leverage. By blending these things together, we get an alchemized approach for exponential wealth building. A few years ago, I heard about a company in Texas by NIW, and they had put together a strategy that they gave it the name Kaizen. It's a Japanese word meaning continuous improvement. And their buzz line for Kaizen: more money, more protection, more confidence. This is the better way. This is the alchemy that I believe is really, really good, that I'm going to show you how it kind of works. If you could design your retirement plan, I mean, we're going to look at any possible idea of what you would want features in this plan. Let's list them. Excuse me. I thought I stopped my phone. Um, we're going to list, if we had this was an open forum and we had the time, would actually ask you to throw out ideas, but I'll just kind of list them as I come up with them. You would probably choose, I want tax deductible. I want to help me save me some taxes today. Maybe another one. Oh, sure. I want my employer to match some money. I want some free money if I can get some free money. You'd want it tax deferred. You don't want to pay taxes as it grows. You'd probably like market returns. You'd like some good market linked growth. Now you're starting to see some things. I don't want any downside. Well, maybe that's not possible. So maybe some of these things are not possible. Well, we're trying to dream of all the features you might want. So no downside. Tax-free. Ooh, tax-free. I don't even want tax deductible or tax deferred. I want it tax-free. That'd be a good idea. No required minimum distributions. You know, when you're my age, you have required minimum distributions from your IRAs, your 401ks. So you're paying tax on these distributions. Be nice to get rid of that. Liquidity. You want to have it available for whatever you might have a desire. And sometimes when you're growing this as a younger person, there's the 59.5-year rule. If you pull money out before 59.5, you have 10% penalty and taxes. So 401ks and IRAs are not very liquid. Penalty-free access for emergencies opportunities. I guess I was just talking about that. Emergencies happen, and maybe the only place people can get some funds is from their 401k or IRA if it's available. Use funds for retirement, business, or major event. I want to use it for whatever and whenever. Creditor protection. Oh, sure. You know, I do make mistakes sometimes. Maybe I need some protection from a creditor who's trying to go after my estate. Creditor protection. Simple, low maintenance design. Oh, sure. I have some pretty exciting investments that I hope pay off big time, but they're much more aggressive. They're not simple. They're not low maintenance, but I like it low maintenance. Would those things be nice? I don't know if there's some others I could think of. Well, Kaizen that I showed you clicks off most of those, but not all of them. All of them except for two. Tax deductible and employer match, the first two. If you'll not take those, not have those, we can give you tax deferral, market link, no downside, tax-free, no RMDs, liquidity after a period of time. I'll have to go over that. Penalty-free access, use for funds for whatever, credit protection, and low maintenance. And guess what? Actually, some things you wouldn't have thought of. Kaizen also gives you a death benefit to the family. Gives you income if you become disabled. Gives you long-term care benefits, chronic illness, if you need to go into assisted living or need assisted living at home. You can pass it to your family tax-free to heirs or charity. And you get leverage, positive leverage. So you get a lot of a dream list, except for the first two, plus some others you probably didn't come up with. Well, that's what Kaizen is. What are the uses? Retirement income. It's kind of the number one. But another one is wealth transfer, transferring some of your wealth to your kids, your grandchildren. And just another use is just plain old life insurance with the living benefits, disability, long-term care. That's a big deal. Career protection, charitable gifting, equalized inheritance. Some cool personal and family uses. And there's some other uses. There's business uses. Employee retention as a benefit. You can help a buy-sell agreement to have money available when that is needed very seriously. You can have it as a key person insurance. One strategy, many applications, all those like personal, family, and these business. All designed to give you more security, more income, more impact. Is it right for you? There's an age range, 18 to 65. You need to be, you're asking for insurance. You need to be standard or better. You can see why some people don't qualify. And you need to have a minimum income of $200,000 to be able to afford these contributions. On the lower side is $20,000 to $40,000 a year for 5 years. And the last, you need to stick with it. This 15-year structure, there's 10 years of funding, 10 years by a bank, and only 5 years by you. And then we need some time for growth. If you can't give this, you shouldn't consider this. That's the important deal. No availability for a while. So let me show you the key points and how this happens. So life insurance, you get the death benefit, protects your family and beneficiaries. You get the living benefits, access for illness, disability, or long-term care. That's pretty important in today's day and age. And it can become tax-free. The Revenue Act of 1913 is the act which brought in income taxes. That's how long we've had income tax in our country. And written into that initial law was the death benefit of life insurance is tax-free. It also grows tax-deferred. And you can take loans from it tax-free. That's how we give you a retirement income tax-free by borrowing from the policy. I'll show you the details. You also have no advisory fees. I charge 1% throughout my career. And there's usually mutual funds had a management fee, but there's no management fees. So there is insurance fees for the first 10 years, but that's part of that initial time. But down the road, this no advisory and management fees makes a big difference. I'm going to list, there's a summary page, the 3 areas. So we've just covered life insurance. It strengthens financial security because you got this protection. It minimizes tax exposure, tax-free. It eliminates hidden costs, management advisory fees. Wow. Let's keep going. I'm going to give you a hypothetical person and show you how Kaizen would fit in for them. I'm going to use a 45-year-old person, male, excellent health, non-smoker. Annual income is $240,000. He already has $500,000 set aside for retirement, and he's willing to put in $50,000 a year for 5 years. He wants distribution to start at 65, and he wants to make sure it's secure and will last through 95. And we're going to use a growth rate of 6.81. The NAIC, National Association of Insurance Commissioners, regulates what growth rate insurance companies can use. And this is the current rate as of October 30th, just a few days ago. And Kaizen's average higher than 6.81, but this is a fair number to use for this hypothetical. We're going to use the income tax rate of 37%, long-term capital gain rate of 20, and state income tax rate 5.5. So I'm going to show you numbers all the way through, and let's get started with a curtain call. If we did 50,000 a year, that's 6.81 into a regular investment after tax, paying tax as we go. At that return, you could have an income of 41,332, and through 95, you'd have an income of 1,281,201. That's 50,000 a year for 5 years at 6.81%. Then, if we did in an IRA or a 401k, it'd be higher, 52,717. That is a form of alchemy. It's a method to get more income out of the same assets. 10,000, 10,000, 11,000. Good, almost 11,000. So 6,634. 350,000 more. So that bottom part there, we're going to fill out as we finish today, and you'll see some comparative numbers. But with that, let's go into the growth strategy. Little history. Term insurance was first invented, sold in 1761. Basic protection. Then whole life came about in 1842, which was a guaranteed cash value, a way to save conservatively. Then Index Universal Life came out in 1997, not that long ago. Gives you growth like the stock market, plus protection. That's what we use. So want to make sure that you're clear on that. So Index Universal Life, here's the features. Growth with protection, market gains, no downside risk. I should probably capitalize the no downside risk. If the market does a negative 30, negative 20, whatever, any negative number, this does zero. You have no downside. You have market gains, but no downside. There is caps and participations that apply. So let me explain those. We have index options in Index Universal Life, and some of the options are capped. So a growth limited by a cap. So there's an S&P 500 option, a stock market option, and you'll have a cap. And the caps change, but currently they're about 12%. So meaning if the market does 15, you still just get 12. If the market does 11, you get 11, 100% of it. But you have a cap and no downside. Other type of indexing is they have participation rate funds, where you earn a portion of the index gains. And it's not 100%, it's 200%, it's 250%. These are more conservative funds. They don't have a cap, and they have a participation rate, almost always more than 100%. Right now, it's quite 250 is pretty common. So you can take a conservative investment of 5% return and get 12.5. I'll show you a little information on that next slide. But very turnkey, minimal management, annual reviews, annual decisions. Very simple. I like this. Growth with no downside and a way to get market returns, and it's simple. Here's how they give you no downside. The majority of the premium is allocated to the insurance company general account, which consists of high-grade bonds. A smaller amount is given for the option budget to duplicate the market. So here's an example. In a 5% interest market, $1,000 going into the cash value, 952 would go in the cash value, and that we know would grow to $1,000 1 year later. And we'd have a budget for options of $48. We buy this options to duplicate those indexes we just talked about. And if the options expire worthless, you still have your $1,000. That's how that works. If the interest rates are higher, like a 15% interest market, excuse me, we have less going into the general fund that grow to 1,000. We have more money going to the option budget, and we can buy more upside, more option budget money to get a higher return if the market does positive. This is really quite ingenious that the insurance industry thought of this. Anyway, market returns plus and no downside. Maybe I should add a slide next time with some performance numbers. But anyway, there's a summary of those points we just mentioned. And there's my during the presentation summary. So the downside protection shields from market downsides, market-linked growth, reduce investment risk, but still have the upside. That's what we want. Then we're blending these with adding leverage. You'll think I'm off on a tangent, but home ownership before 1934, mortgages required 1/2 down and 1/2 repaid in 5 years. Well, I wasn't around in 1934. I didn't know that. But 1934, FHA created the 30-year loan, which revolutionized home buying. Before 34, 40% were able to buy a home. Today, 66%, a lot more. 85 million residential mortgages currently outstanding at 12.6 trillion. Mortgages were a big plus. You know, leverage, borrowing money, that's what leverage means. It's positive for a home ownership. It's been a boom for our country. You can use leverage to help you with a real estate investment to get more return, with a business investment or education. There are negative times when leverage is not good. Borrowing for a car that's going down in value. Borrowing to pay for healthcare costs. Don't like that. Borrowing everyday essentials, card charging thing on a credit card and not paying off the balance. Ooh, major life investments. Leverage can be good. It can be bad. Here's some pictures of Barbara and I from a trip we took to Cabo in September 2024. This resort had a cameraman, a photographer, that for a fee you could hire him and you'd wander around the beaches and would take pictures. And he took a lot of pictures, but these are probably 4 of the best. I like them. I think I'd like to do this. Whenever any resort has a feature like this, I'm going to do this. Anyway, why are we not using leverage for our retirement? You notice that leverage, they didn't have retirement in there. Well, we're saying with Kaizen, you should. We're adding retirement planning and asset leverage to help you have more in retirement. Here's how we structure this. Strategic leverage, 2 to 3 to 1 range. Bank funds 50 to 75% of your premiums with no collateral or loan payments. 5 annual payments, can't play 5 years. Bank funds for 10 years. With Allianz, you can actually have monthly payments for 5 years. Trust ownership. By doing this, we provide protection, privacy, and professional management. So you have creditor protection, and the trust is the one borrowing the money, doing all the behind the scenes work. And there's a bunch of built-in features that we've tweaked and done to make this Kaizen work? I've got a pretty long list. Protection riders, death benefit B, option B, supplemental term. These are all part of it, but I'm not going to explain these today. Any of you who have questions on these and how important they work, I'll be happy to go over them. So Kaizen had 5 annual payments. That's the silver pigs. And the bank is putting in approximately the same amount as you are in the first 5 years. After 5 years, you're done. And then the bank is making your payment, what you're paying, plus theirs for the next 5 years, roughly 3 to 1, 2 to 3 to 1, closer to 3. All without the typical risks of borrowing, no credit checks, no loan documents, no personal guarantees, no signature on some loan, no collateral. You don't have a loan. That's really a big deal. How's this Kaizen doing? The very first policy was issued in 2012 by one of the owners of NIW. This is the first policy. And you get an annual statement. And this annual statement, the last that we have a copy of, is June 26, 2024. As soon as they show the June of 25, I'll change this. But here's the performance from 2012 to 2024. Average return is 7.73. Nice. That's nice. Could be higher, but that's nice. The average stock investor, I believe, is making the same period of time about 7. We've got fees, or advisory fees, management fees. We got them jumping in and out of the market. The average investors do that and get less return. So I believe 7.73 is nice. The average interest paid on this very first policy is 3.81 for those years. And so we have something called the spread. We take the return, 7.73, subtract the interest rate paid, 3.81. So we've got a spread of 3.92. This first policy is made 3.92 on the borrowed money, and 7.73 on their money that they put in. This spread, this leverage, gives you money on other people's money, helps you have to put in less into your investments for your retirement or whatever. We did some back testing. We back tested to 1930. That's a long time ago. There's never been a 15-year period of time with less than a 2% spread. Wow. You mean I can probably plan to get 2 or maybe 3.92, maybe higher, but 2 on borrowed money? There will be negative years when the market's negative and you're getting a 0, still paying interest, but there's never been a 15-year period of time with less than a 2% spread. That's cool. And I mentioned the trust. So we set up individual trust for every policy. So you have your policy in a trust. Then we have this master trust. The master trust is doing the dealing with the loan and managing all the day-to-day stuff. And that takes place, you have this master trust involved through 15 years until they pay off the bank. So I like doing the curtain calls. We had this chart a while ago, after-tax return, tax-deferred return. Now I'm going to show you the Kaizen return. And so I have a drum roll, please. Is it going to be 62, 72, 82? What is it going to be? And the curtain call says it's 100,000. It's more than double the 41,000, almost double the 52,000. 3,100,000 instead of 1,200,000. More money from the exact same investment. And you had an initial death benefit of 1,438,000 when you purchased it at 45, and I've got to fix my number there. Death benefit still, it was 90 or 95 of 1,299,000. So you've got income, and you could still be getting income after 95 if you're still alive. The other two, we've used every penny. There's no more money left. So Kaizen is looking really, really good. Well, what about bad times? The Great Depression, the 30s, were horrendous. I wasn't alive. You weren't alive, but my parents were. From 1930 to 32, the stock market lost 70% of its value and did not recoup that losses until 1959. You don't have any losses any year. So the worst you could have in the depression in this product would be 9. We're going to simulate 9 years as zero out of a 12-year period. Can 9 years of zero keep this thing alive? Wow, we're going to show you. We also hypothetically tested it for the 1980s of high interest rates. Interest rates got as high as 16.88%. Well, can Kaizen survive these bad times? Here we go, a curtain call, and here's the numbers. For the 1980s, it'd be, instead of 100, it'd be 75. Ooh, still almost double the 41. And what do we got? 23,000 more than the tax deferred. And even in the stress test of the Great Depression, 65,000 still beat the aftermarket. And that's the worst of times. I like that, something that works even in bad times. Got one more thing to show you. What if you got a double? Instead of 100,000, you got 200,000. Oh, now, Jim, are you dreaming now? Let me tell you. Allianz is one of the insurance companies we use, and they wanted to evaluate our software that we're crunching all these numbers with. And they looked it over very thoroughly, and they said, looks okay. In fact, we think there's an 80% chance that the money's going to be double. Instead of 100, it'll be 200,000. 80% chance. Now, we've got a range from 65 to 200,000, or probably 100 or 200,000. Instead of a 3,100,000, 6,200,000, a whole lot more income than that 1,281,000, and an 80% chance. And no downside, tax-free. Wow. So here's the last one. Leverage cuts capital outlay. You don't need to put as much money aside for the future. 5-year prevents payment fatigue. So many people quit their life insurance policy payments because it just keeps going and going and going. Only 5 years. Trust ownership reduces liability risk. Turnkey reduces complexity. Liquidity after the 15 years improves future accessibility. These are some cool features. These are the benefits of Kaizen. Well, we're getting close to the end. There's a 7-point risk matrix thing that the investment world talks about. And so risk-free, number 1, is FDIC insured savings. And low risk is government bonds. Then the other area is 7, extreme risk, cryptocurrency, option trading, startups. 6, private equity, speculative real estate. And of course, you've already noticed I don't have those 3, 4, and 5. Where's Kaizen fit? I'll show you. Kaizen is moderate to low, just the same risk level of high quality corporate bonds and annuities, less than a balanced stock portfolio, less than a stock heavy portfolio, premium finance, just a little bit over the low risk area, moderate. That's kind of cool too. I mentioned some tools. We've got 2 landing pages that are packed. They got videos, chapters, explanations on leverage, everything. You don't have to have an email. I don't have to have your email or your social security number or your cell phone number to access this landing page. There's the QR code. This will let you discover and look at Kaizen to your heart's content. As you have questions, my phone number is on the landing page that you're going to get. There it is on the top. You can call and ask me questions. Happy to help. It should answer most of your questions, but it's really excellent landing pages. This is the first one. The second one is Kaizen for a special purpose, gifting. This is with a slant of gifting assets to your kids and grandkids. I don't have a QR code, but if this is your interest, just text me, email me, whatever, and I'll send you the link. Again, you can explore it on your own. You don't have to worry about me bothering you. If you want to do a gifting process. So these 2 landing pages are really your primary tools, but I think my website is dynamite, and I have a lot of stuff on it. I have some quick links for a lot of information you can go to, and I've got a retirement calculator, gap calculator that I built and designed. That's simple. You can put in your age, your money you have, what growth rate you're going to get, tax, inflation rate, and you'll calculate your gap, what you need to solve for and what you need to get some money set aside for to fill this gap. I have a more complex calculator, the advanced, that puts Social Security in and asks every possible question I can think of. These are free on my website. You don't need to ask permission to use them. They're there. I'm working on another presentation. I'm using some acronyms. Now, this is probably just a preview a little bit. I got the Kaizen engine, the lift up, leverage, income, 5 payments, tax-free, upside protection. I'll be working on this further. Then I've got a second acronym, L-Shield, L-Safe, Legacy, Security, Agreement-Free, Fixed Commitment, Easy Management, and the last, Flex, Flexible Life Protection, Exemption from creditors, exempt from RMDs. This is something in the future. I'll be working on this. So these 3, the lift up, the L-Safe, the Flex, how your wealth grows, how your plan endures, how your freedom expands. And I put a compliance info at the end of the presentation today. But that's it. And that's that QR code with that landing page. I can leave this up for a moment, and you can look at it at your heart's content. But that's our 12:34. I like to keep it about a half hour, just a little bit over. But thanks for attending today. I didn't take the time to answer questions. I'll look through those, and I'll send an email to all those who ask a question to respond to those. Have a great afternoon. Bye.